Mark Wilson, the figures you're unveiling, they look good. Are they as good as they seem?
You know, John, I want to get Aviva to get a reputation for doing what we say we're going to do. We've got a number of key metrics and they're all moving in the right direction. So it's been a very satisfactory set of results. If you have a look at some of the underlying figures, our net profit after tax has moved from a loss of 3 billion to a profit of 2.15 billion. That's some good progress. If you have a look at expenses, they're down about 360 million. Cash flow to the group, which is a pretty important metric, that's up 40%. And then look at the growth metrics like value of new business. Value of new business is up 13%. Now all these key metrics are above consensus in the market. That's helpful, but we know we've still got a long way to go.
Yeah, isn't there going to be a tendency for people in Aviva to think, whew, we've turned this round, we can relax now?
You know, I think that's an issue with turnarounds. When you do a turnaround, the tendency for people is to focus on all the successes and celebrate them and not focus on the issues. That leads to complacency and that leads to poor results. I want to guard against that complacency at Aviva. I want to make sure we focus equal attention on the issues and then make sure we deliver what we say we're going to deliver.
You've talked about a number of key metrics, but you're laying an emphasis on one in particular, namely cash. Why?
Well, cash is important. Cash brings clarity, cash brings certainty. Cash in a business, in my mind, is still king. We can use whatever accounting basis and whatever metrics we like, cash is still king. The problem at Aviva was never profit. Aviva's a profit-making machine. The problem was turning that profit into cash at the group level, getting the cash up to the group so that we could increase dividends, we can pay down debt. So cash is important. And the whole market's been rightly focused on that as a key metric. Now that metric's gone up by 40%. That's certainly a bit ahead of expectation, where we thought would be at this time. And that's helpful. It gives us more financial flexibility.
You said you want to cut out fat in Aviva, and I think you set a target of £400 million. Are you there? Have you got there yet?
Yeah, well, the £400 million target was for 2014. We've just delivered a result of £360 million reduction. That's quite satisfactory progress. I think that's entirely adequate for what we were planning. And that has come through to the bottom line, and that's pretty helpful. We still have more to do, and our expenses are still too high. Part of what we want to do is reallocate some of future expense reductions. We want to reallocate that to other initiatives. Initiatives like digital, initiatives like automation, initiatives like investment in our predictive analytics of our underwriting, which will improve our business long term.
What is the value of new business? I mean, is there growth in life insurance?
It's easy for anyone in a business to just get pure growth. It's easy to get top-line growth in an insurance business. Anyone can do that. That's not where I want to focus Aviva. In Aviva, we want to focus on what's valuable growth. Now, you can define that in life insurance by value of new business, or V&B as we call it. That's the value of the new business you sell. That's the profitability of that new business. And so that's the key metric we want to grow. And the results were pretty compelling. We focused very much on our balance sheet, fixing the balance sheet and ticking off those issues. But as we tick those off, people ask that question, well, where's your growth coming from? I think we've shown in 2013 we've got some pretty exciting markets to focus on. Things like Indonesia. We recently did a deal with the Astra Group. They're an outstanding conglomerate. They're the largest conglomerate in Indonesia. They have extraordinary distribution power. And so we can help tap into that extraordinary distribution power, bring our life insurance experience to them. And that's the sort of businesses that you'd expect to see delivering over the years to come.
You talked about the boxes that you've ticked, and we've talked about a lot of boxes ticked. What about the combined operating ratio, which I know is your way of measuring how general insurance is doing? How's that going?
Well, I think that was marginally disappointing. It was flat over last year. It was actually marginal deterioration. It went from 97 to 97.3, albeit a little bit ahead of consensus. But I think we were impacted in part by the weather. We still need to see some of the predictive analytic work come through broadly. But one of the advantages of Aviva on that combined ratio is our diversity. We're diverse in terms of product lines and we're diverse in terms of geographies. So we were certainly impacted less than a number of our peers.
When you say affected by the weather, what do you mean? The flooding here, or was it because there have been other parts of the world that have also suffered very badly?
Well, Canada had a 1 in 200 year event that impacted us, which we told the market about last year. The flooding here in the UK has been a significant weather event, albeit so far in 2014, the claims we've paid have been very much in line, or marginally, maybe marginally worse than in line with our long-term average. And I think that probably shows the strength of our underwriting capability and our predictive analytics. That has given us a pretty good result in that area.
You're a consumer-facing business. What can you do as the CEO to help people when the floods are there and to show that you are in touch with what people's genuine concerns are?
Well, the floods are one of the tragic moments and one of the events you see how they impact people's lives. And we've seen the floods both in Canada and we've seen them more recently in the UK. What can we do? Well, what I've done is I've gone out and seen these customers. I've gone up to Somerset and Worcester and Gloucester, and I've been standing in people's homes, in my wellies, in their kitchens, sometimes with water up to just below my knees. And they're telling me the tragedy, how they've lost their dream home, how their lives have been turned upside down. These are the moments of truth. These are when we deliver or we don't deliver. You know, when you see it like that and you see the impact, you see also how our frontline people really go out of their way to deliver in these times. We've had people on the road 7 days a week helping people claim, knocking on our customers' doors to help them to claim. We've had people, what we call the Aviva Army, in yellow raincoats filling sandbags to help people protect their homes. And over this entire period, since the floods began in the UK, we have accepted 99.9% of these claims, and we're helping people get through it. This is when I think we deliver, and through these floods, I think our people have been quite exceptional.
Very interesting. I want to talk to you about a subject I know, and I know you do a lot of meetings with investors and shareholders, and I gather it comes up every time you go out, and that is the intercompany loan. You're saying that this year you are taking that off the table. You're not sweeping it under the carpet, are you?
Hardly sweeping under the carpet. I'd argue we've brought it out into the sunshine. As you say, I've had several hundred meetings with investors over the last 12 months. It's been raised in every meeting. Partly the reason it's been raised is because I've highlighted it as an issue. It's an issue because investors were concerned that there would be a lot of cash needed to fix and reduce this internal loan, and that would be cash that would be taken away from dividends or cash that would be taken away from reducing external leverage. Over the last 12 months, we've reduced this by 1.7 billion. And just putting that in context, that's at a time when I said we'd reduce it by 600 million over 3 years. So I think we've exceeded expectations there. What we've announced in the results now is that we will take that loan down to a sustainable level of 2.2 billion. And we'll do that through a mixture of cash and non-cash. But for the cash part, that's from our existing liquidity resources, so it won't take away from the future cash generation of the business. A few important points to note here. We've been working very closely with the regulator. The regulator has agreed and signed off. This is the PRA. They've agreed and signed off our plans. And I think we'll probably get a bit of credit for the progress and the track record we've had on this in the last 12 months on delivering. So yes, I believe we've taken it off the table, and I believe we've taken away what's quite a major overhang in our stock.
So the investment thesis is cash flow and growth. Cash flow, looking good. Where is the growth coming from?
And that's the inevitable question. As we tick off all the balance sheet issues, the next question is, so where's the growth? Well, we've got 13% growth in terms of value of new business over the last 12 months. That was probably a bit higher than even I was anticipating. Now, just to be absolutely clear, I believe we need growth out of all our markets. I don't care whether you're a cash-producing market, like the UK or France, or a turnaround market like Italy, Ireland, and Spain, or an emerging market like Turkey or Poland or Southeast Asia or China. I expect all these markets to deliver growth. France was a good example. France had about 39% growth in value of new business in a market where people say is mature and the economy isn't that robust. So they've proved they can do it. Look, another one, Asia, 65% growth over the last 12 months. They had I'll call it highly satisfactory result. And the turnaround markets, though, just for a bit of balance, the turnaround markets still need a lot of work. Italy and Spain were well down in value of new business, albeit all of those businesses paid a dividend. And so that's